Welcome, homies and homettes. My name is Kevin Strong, and welcome to the Kevin Strong Show. And in this video, we're going to talk about mortgage discrimination, basically dealing with the elderly. And we're also going to talk about what everyone else is talking about on the internet. What happened to that bank called Silver? High hold silver, away it went, right? Silvergate. So we're going to talk a little bit about that. But the first half of the video, we're going to talk about discrimination against the elderly when it comes to them applying for a mortgage. If you're new to my channel, first of all, welcome. I'm going to ask you to humbly subscribe to my channel. Smash that like button at the end of the video if you enjoyed the content, and please feel free to leave a comment. So without further ado, we're going to go ahead and jump into this here. Let me switch my screen here. And like I said at the start of this video, we're going to basically talking about older mortgage applicants and how they're being systematically, at least based on some of the data, being discriminated against because of their age and mortality rate. So this presentation basically deals with, like I said, mortgage stuff. And on the back half, we're going to talk a little bit about the banking system and what happened with Silvergate. And the source of my mortgage information was basically Yahoo Finance. So let's go ahead and jump into this here. Here's some interesting stats. The older you get, the weaker your chances are for getting approved for refinance on your mortgage, according to a study that was, like I said, once again, I got from Yahoo Finance. Rejection rates spike the most after the person crosses the age of 70, and it's more common with men. Not so much at the same rate as women, because statistically speaking, women do live longer than men. The rejection rate for mortgage applicants between the ages of 50 to 59, and there's some stats here, 1.07, 18 to 24, 1.54. And then folks between 60 and 69, it's 2.7% higher for applicants over the age of 70. And then overall, the rejection rate across all borrowers, regardless of age, is roughly around 17.5%. From a residential standpoint, obviously, they're evaluating your credit score and your income, and more than likely your reserves. Just as a full disclosure, I am also a licensed mortgage broker, and I am a licensed real estate agent. Okay, it's all in the numbers. So this kind of is a self-explanatory graph here. As you can see to the right of this particular slide, the relationship of age and demographics to rejection of mortgage applicants. This is kind of like a visual of what I was just going over from the previous slide. So I'm not going to go ahead and go through each age group, but I'm just going to kind of focus on the older. As you can see, from 50 on up is when you start to get a significant high rejection rate. Then obviously at the bottom, statistically speaking, Hispanics and Blacks, statistically speaking, are more inclined to get rejected for a mortgage than their white counterpart. This is not an inference. This is not a joke. This is just some statistical information. You can spend a whole video going on to social and economic factors that lead to that. And then some of it's just blatant racism. There's just no other way around it, but I digress. So just look at that for a second, and it kind of is, it's very alarming to see as you get older and you kind of need sometimes to tap into the equity of your home because you're on a fixed income at the most inopportune time that you need to draw on that cash. You may not get that refinance loan that you need from your lender. So let's talk about some of the reasons why this happens, right? The rejection rates accelerate every year after the age of 70, spiking to 12% by the age of 90. The findings also conclude that rejection rates among women increased at a slower pace compared to men. As I said before, probably because on average, women live longer, especially when they're getting a check. I'm kidding. Don't unsubscribe. That was just a joke. You know, I can't go a whole video without making a joke. Insufficient collateral is also consistent with older applicants who are forced to carry a mortgage into retirement, being more financially distressed. And they also probably have some maintenance issues with their property. Contrary to popular belief, guys, this is kind of a side note. You would be surprised the number of people who are receiving Social Security and part of their Social Security check is getting garnished to pay back student loan debt. I'm not making this stuff up. I had several clients last year when I was operating in that space. And, you know, this lady's like 68 years old. and it's got a good chunk of her Social Security check still being garnished because she hasn't paid back the student loans, or she co-signed for someone, that person defaulted, and now the collection company is coming after her. So obviously the Consumer Financial Protection Bureau clearly says that it's illegal to discriminate based on age, but as well as I do, these banks are basically legal crooks. They can find a way to circumvent the system and come up with a plausible explanation as to why you were denied the loan without blatantly coming out and saying it's because of your age. Here's an interesting thing. Now we're going to kind of transition a little bit over to housing a little bit. So this was an interesting graph because you can kind of look at it. So between March 2020 and May 22, there's some keynotes here. San Francisco, how it spiked, and now how it's going down. So the easiest way to look at this graph is that from 2020 to 2022 shows these particular cities on how much they've gone up in price and equity. Conversely, the red portion shows you how fast those prices are going down. Once again, my backyard, Seattle, is at number 2. Number 1 was San Francisco. And as you can see here, it's kind of self-explanatory. Phoenix and things like that, Las Vegas. And these are some of the cities that are experiencing the biggest housing declines because they just went up so much within the last 2 years. Here's another interesting stat, excuse me, that basically shows home prices are falling for the first time since 2012. Once again, I'm going to keep this very simplistic. Where you see red and that red is pointing down, that's bad. And where you see the green, that means things are doing well, and that is good. So as you can see, starting in 2022 is when things started to go bad, as illustrated by the graph in red. And you have to go all the way back to 2012 before you get to a point where you see that again. One thing I like to point out to you guys, and I've said this ad nauseum, excuse me, is that one of the ominous things that we're dealing with now that we did not have to deal with in 2008 is inflation. Inflation was not on the table in 2008 when the housing market imploded, but it's certainly a factor in today's housing environment. So here's some final thoughts. All signs point to an economic collapse in the coming months almost. This is my humble opinion. This is not financial advice. We just witnessed the second largest failure of a financial institution in the United States history, right? Silicon Valley Bank. In 48 hours, it was gone. It was gone, gone, gone. Home sales have fallen for 12 months straight. This is the longest stretch since 1999. We're starting to get some ominous setups here that indicate that part of this pending housing market and financial system may not only replicate what happened in 2008, it might get much, much, much worse. Planned layoffs soared 427% in January and February, the highest spike since 2009. Once again, as you can see, these are statistical, factual information that I'm conveying to you guys. And there's a lot of ominous signs that point back to what? 2008, 2009, 2012, right in the wake of the great financial recession. Medical bills are responsible for almost 60% of all bankruptcies in the United States. So contrary to popular belief, guys, a lot of times when you see somebody who has a bankruptcy on their credit report, it's not necessarily the person is just going out and being irresponsible and basically they're a deadbeat. A lot of times it's medical bills, as this stat points out. So everybody knows how expensive good quality healthcare is. And if you don't have adequate insurance, it doesn't take a lot to have something to happen to you, or you basically have some type of illness that's not covered by your healthcare plan. And as a result of that, you can easily be pushed into bankruptcy as a way to basically try to get out of that debt. Now, getting back to what happened in Silvergate, this is something that I can't definitively say this is the source, but I've been doing some research and I've heard various rumors that 90% of the accounts in that Silvergate bank that basically imploded this week, have accounts over $250,000. Now, FDIC only insures up to $250,000. So there was a run on the bank this week, and those people who didn't get their money out, now that bank is in what's called receivership. There's a pause right now, and now the FDIC has stepped in. So if it's true that 90% of those remaining accounts have over $250,000 in that bank, they might not get their money back. Once again, I did a whole video talking about FDIC. It basically can only fund about 1 to 2% of all deposits in the United States. So 98% of you who have money in a financial institution under $250,000, which you would think you'd be covered by FDIC, that entity is financially insolvent. So if we have a massive bank run on a national level, or this starts to get contagious, don't be surprised if your temperature starts to rise, if you go inside your financial institution and they say, we ain't got it, homie. Ironically, the CEO of that bank sold over $2 million of his company stocks just 2 weeks before the bank became or went insolvent. You think he probably knew what was going on. You know, you just can't make this stuff up, guys. It's just a very, very, very sad situation. So the elderly people are getting squeezed. I did a whole video talking about your health that wasn't meant for certain individuals. So I'm not going to go there. So there's a couple of people that was on my Facebook page, and now they're not my Facebook friends anymore. Not that I give a shit, but the point is that my information talking about health and taking care of yourself was not slided towards those individuals. It's just not. That's just something somebody who knows me, I'm very, very passionate about, because as you get older, things start to break down. And that's when basically the whole system seems like it wants to squeeze the most out of you when you are the most vulnerable. So I hope you guys got a good sense of this video today. It's important, like I say, to keep your credit score up and your debt down. Find someone who's really, really, really on your team, and you guys can work through a lot of things. You know, I was thinking about something this morning before I did this video. And you've got like a seesaw, and I think that device that's underneath it, it's called a fulcrum. And you're constantly balancing up and down. Find somebody who's willing to balance life with you, not against you. If you have to constantly remind somebody to compromise, to move to the middle for the better of the relationship, they're not open for compromise, because you don't have to consistently remind somebody to do the right thing. So I hope you found this video in a good place. Please comment, because I share. If you have not subscribed to my channel, I humbly ask for your hand, only on the like button. This was the Kevin Strong Show, and I'll see you guys in the next video.